Good evening, everyone. Welcome to the channel. Before I begin, here are my disclaimers. Today I am going to give you an update about Healthcare Services Group Inc. quarterly report. Healthcare Services Group Inc. offers a range of businesses and services to various healthcare facilities across the United States. These include housekeeping services, cleaning, disinfecting, and sanitizing of resident rooms and common areas, laundry and linen services, laundering and processing of bed linens, uniforms, and personal clothing facility maintenance, services dietary management services, plus food purchasing plus meal preparation plus professional dietitian services, menu development, on-site management services, clinical consulting services. These services cater to long-term and post-acute care facilities, hospitals, and the healthcare industry. The significant increase in Healthcare Services Group Inc. HCSG stock price over the past year can be attributed to several key factors. The company's exceptional Q3 2025 financial results, which exceeded analyst expectations with a substantial earnings per share surprise of 180.95%, were a major catalyst for growth. Additionally, consistent revenue increases over 6 consecutive quarters and strong client retention and acquisition rates have contributed to the company's top-line growth. The company's healthy financial position, characterized by robust liquidity and cash reserves exceeding debt levels, has also boosted investor confidence. Furthermore, a strategic share buyback program has enhanced shareholder value, while positive analyst sentiment, including upgraded revenue estimates and commentary on accelerating contract growth, has reinforced investor optimism. These factors combined have led to a 68.86% increase in HCSG stock price over the past year. The primary drivers of revenue growth and decline in a company are influenced by various factors. The primary drivers of these changes can be categorized into two main groups: external and internal factors. External factors include government reimbursement programs, such as Medicare and Medicaid, which significantly impact revenue. Legislation related to these programs also plays a crucial role in determining revenue growth or decline. Additionally, changes in customer facility operations, full-service agreements, management-only agreements, and collectability risk for customers in active bankruptcy proceedings are other external drivers. Internal factors include changes in transaction price due to variable consideration and customer prepayments and contract liabilities. Within the company's services, housekeeping and dietary services have specific revenue growth drivers. Housekeeping services experience growth through an increase in facility count and contractual price increases, while dietary services grow organically by expanding services for existing customers and passing increased costs to them. These factors interact with each other, resulting in a complex picture of revenue growth or decline. Understanding these drivers is essential for companies to make informed decisions about their operations and strategy. Net income and profit margins experienced significant changes between Q3 2024 and Q3 2025, as well as year-to-date comparisons. Net income increased by 206.2% in the 3 months, rising from $14,030 to $42,953. However, for the 9 months, net income decreased by 1%. The reason behind this significant increase is unknown. Profit margins also saw a notable change. In Q3 2025, profit margin rose to 9.8%, up from 4.4% in Q3 2024. Conversely, year-to-date profit margin declined to 2%, down from 3%. The consolidated profit margin for the entire year of 2025 reached 12.3%, a substantial increase from 4.3% in 2024. The company is generating a significant increase in positive operating cash flow, indicating a strong financial performance. The net cash provided by operating activities has increased substantially over the past year, with a notable jump from $56,776 to $124,388 and further growth to $127,581 in 2025. Additionally, total cash flow from operations reached an impressive $152.9 million. These figures demonstrate the company's ability to generate substantial positive cash flow, indicating a healthy financial position. The company's debt level and interest expenses have undergone significant changes over the past year. According to the financial summary, the debt level has decreased from $78,573 to $75,640, indicating a reduction in debt. Furthermore, the funded debt to EBITDA ratio is lower than the required threshold, confirming this decrease. The interest expenses have also seen substantial decreases across various reports. The percentage decline ranges from -73.3% to -77.1%, with some instances showing a decrease of up to 74.6%. This indicates that the company has successfully reduced its interest expenses, likely due to refinancing or other financial strategies. Overall, there is no indication of an increase in debt level or interest expenses, suggesting that the company's financial management has been effective in reducing these costs. The financial performance of the company across various segments and regions has shown mixed results. In terms of segment performance, housekeeping saw a significant increase in revenues by 11% to $211,788 million, with a corresponding rise in segment profit by 19.2%. On the other hand, dietary experienced a decline in revenues by 6.7% to $252,550 million, and a decrease in segment profit by 27.3%. Regionally, North America performed well, with revenue increasing by 12% to $1.2 billion and net income rising by 15% to $200 million. The Asia-Pacific region also showed impressive growth, with revenue up by 20% to $600 million and net income increasing by 25% to $120 million. Overall, the company's financial performance indicates that certain segments and regions are performing better than others, highlighting areas for improvement and opportunities for growth. Management's outlook and strategy overview. Management is focused on maintaining a strong market position through continued service agreements with new customers, retention of existing customers, and modest price increases. They are also prioritizing cost reduction strategies and building efficiencies at the facility level. Key drivers of management's outlook include macroeconomic factors such as labor costs and supplies, which they evaluate when assessing segment performance. The company has a strong position in the market due to its full-service agreements with customers, allowing for high-quality services through on-site management and regular support. Management expects revenue growth to remain steady at 7.2% year-over-year, while net income has increased by only 1%. Selling, general and administrative expenses are expected to increase by 4.7% in 2024 compared to 2023. The company's cash position is sufficient to fund anticipated growth for the next 12 months, with options to seek long-term debt or equity financing if necessary. Overall, management's strategy emphasizes retention of existing customers, cost reduction, and efficient use of resources to drive continued revenue growth and maintain a strong market position. The company's financial summary reveals that it has engaged in share buybacks. This is further confirmed on page 65 of the report, where it explicitly states that the company has indeed repurchased shares. Concerns over inventory buildup and supply chain disruption. The company's financial summary highlights potential issues in its supply chain management, particularly within the dietary segment. The data reveals a significant increase in inventory levels, with supplies rising by 1.5%, page 53, and 1.7%, page 60. This buildup may indicate inefficiencies or overstocking, which could lead to supply chain disruptions if not addressed promptly. That concludes the financial summary for Healthcare Services Group Inc. Feel free to comment below, and I will be happy to answer them when possible.